Now, the second course module I want to share a little bit moments would be competitive intelligence and benchmarking. And here we tell students how to define problems and diagnose root causes like a consultant. Now, I want to share a few moments. You'll see how important this is. So this module starts with industry analysis, right? For companies to assess the industry potential of their risk, right? Is this industry we want to carry on, we want to stay, right? And the second part is competitive positioning, right? Is really how to position our company in the competitive landscape, right? To see where we stand. Right. So essentially, we want to find all the competitors and compare the competitors with us, right? And do the third step, which is enterprise diagnosis, to define or discover problems and diagnose root causes. This is extremely important for companies, especially from the management perspective, right? Now, the case will be American Airlines in the U.S. airline industry. And lecture time is about 60 minutes. And homework, the homework is the most fun part, right? We'll ask a student to find a company in trouble and using the skills learned, right, to define problems and diagnose root causes for that company. And also share their findings with the rest of the class. We show the student testimonials, analyzing market positioning through competitive intelligence and benchmarking proved highly informative. The competitive intelligence session was another favorite because it shows how to analyze companies and spot problems like a consultant would. I find competitive intelligence and benchmarking especially relevant and insightful, right? Working with real-world data and solve realistic supply chain problems helped reinforce key analytical skills. A topic I feel most relevant or so on and so forth, like getting to know more about industries I'm interested and observe their analytics through vast amount of data. Now, we typically start with a company in trouble, but how do we know a company is in trouble? Right, the easiest thing would be just looking at the stock price growth, right? So here we use the American airline industry, right, in US as example. We find that American Airlines, in comparison with its peers such as Delta and United, right, performed the worst in recent years, right? This is the stock prices from 2018 to 2025, right? The entire airline industry is in bad shape. If you compare them with the S&P 500 index, however, American Airlines especially is in the worst position. Right, so clearly American Airlines is in trouble, right? So what is the problem and what are the root causes? So to answer these questions, right, the companies typically have to hire a consulting company and spend millions, right, on that. Now using data analytics, right, let's give them a free consultation, right? Okay, so the analysis were broke down into the following questions. Right, first, what is the market potential, risk, and trend for the airlines industry, for example, right? And also along the airline industry supply chain, right? What are the most valuable segments? Now, the reason we want to do this analysis, right, is to help company make the decision of whether to stay with their core business or expand, right, their business along the supply chains. Now, questions such as, where do I stand in the competitive landscape? What are my strengths and weaknesses, right, relative to my competitors? And what factors may drive a company's financial performance in my industry? Right? And of course, what are my key problems and causes? Okay, in the next 5 minutes, I'm going to tell you convincingly what is American Airlines' biggest problem and what are the root causes. Let me skip those industry analysis first. You can see this in a teaching deck. Let me fast forward, right, to the positioning in the competitive landscape. Let's plot the U.S. airlines and U.S. air freight logistics together on the same map. Right, here is total revenue versus total cost. We can clearly see, right, here are the big three, the top three airlines, right? United, Delta, and American Airlines. They are very comparable in size. Only other airlines such as Southwest, right, and Alaska and so on, they're much smaller than the top three. And we can also see, right, an airline often also have a business in air freight, right? However, you see the regression line, right? They are almost the same slope. So meaning if an airline move towards air freight, it's not going to make airline very rich, right? It's almost equally scalable. Now, let's also look at the competitive landscape, right? In terms of return versus risk. So we have liability asset ratio on the x-axis, return on assets on the y-axis. And we can see that American Airlines here, right? The return on assets is not very high, but it's still positive, which is good. However, if you look at liability asset ratio, it's already above 1. So American Airlines actually has heavy on debt. Now, if you look at Delta and United, they actually are much better in both ways, right? Return on assets and also their liability asset ratio. Now, well, if you look at all the other smaller airlines, actually they are in pretty bad shape. They have negative return on assets. Also, they have liability asset ratio greater than 1, right? So although American Airlines is not performing very well, it's better than the other smaller airlines. So airlines is really tough business. Okay, now let's look at driving factors. For the US transportation industry, let's say including all transportation modes. For S&P 500 companies, we observe a strong negative correlation, right, between the liability asset ratio versus return on assets. So that means with a R square like 60%, right? That means if a transportation company is heavily in debt or have a lot of liabilities, right, that tends to drive down the return on assets, right? So higher liability asset ratio may lead to a lower return on assets. Now let's look at American Airlines, right? Key problems 2024. So have a revenue breakdown. So we break down the revenue, right, by their cost of goods sold, by their SG&A, and so on and so forth, right? We can find first observation, right? The airline industry, at least for the US, actually, I think it's the same for other countries as well. It's a very tough business. You look at this, the cost of goods sold accounts for 77% of the revenue on average for the entire industry. And if you look at net income, that's our profit, right? On average, about 2.76%. So they sell you a ticket of $100, right? They make $2.76 as the net income, that's the profit. It's not very profitable, right? It's very hard money to make. Now, for American Airlines, is even worse. It only made about $1.56, right? And about Delta and United made more, about $5 or $6, right? Now, if you see the key difference, right, you'll find that American Airlines' key problem is that although it has strong demand or strong revenue, but its profitability is weak, is very weak. That's American Airlines' key problem. And the reason for that is cost of goods sold is higher than industry average. But for the top three, the other two of the top three, right, Delta versus United, they're much lower than average, right? They have better cost of goods sold. Okay, still, but the cost of goods sold has a lot of different costs for airlines, right? So what is exactly the root cause, the problem? So let's have a breakdown of the cost of goods sold. This is the breakdown of cost of goods sold, right, for the airlines. And the root cause we're not in here. We find that the rent and netting fee for American Airlines is much higher than its peers. And fuel and power gas cost is also on the high side, right? Operating maintenance cost is also higher than its peers. So these contributes to the higher cost of goods sold. Now, if you look at the staff cost, the staffing cost, that's the pilot, that flight attendant, and so on, the cost actually is similar as the peers. Okay, this actually shows a hidden but serious problem. If you combine these, the similar staff cost with their labor productivity, it turns out in all these years, American Airlines here in the blue line, right, labor productivity is much lower than the peers. So what's labor productivity? It's really revenue divided by the employees. It's much lower actually. So in year 2024, the labor productivity for American Airlines is one employee made about $410,000 dollars of revenue. But if you look at Delta, one employee contributes to about $600,000 dollars revenue, right? So and remember, they have roughly the same revenue, right? This means American Airlines hire a lot more employees than Delta, and together with the same spending on staff cost, right? American Airlines workforce compensation is definitely less competitive than its peers. Okay, so American Airlines problem, right? They spend too much money on these items in the cost of goods sold than their peers, and they also not compensating their employees competitive enough. That was the key problem.